from the CUBE studios in Palo Alto and Boston, bringing you data-driven insights from the CUBE and ETR. This is Breaking Analysis with Dave Vellante.
Dell's founder-led business is one of the most remarkable and underappreciated stories in tech. Dell Technologies is not particularly sexy, nor does it put forth an earth-shattering vision that bends the mind. Yet, it's a company that has consistently figured out how to ride successive waves without becoming driftwood. And like Hyman Roth of Godfather fame, Michael Dell always seems to make money for his partners. Unlike Roth, Mr. Dell is not a gangster. Rather, he's a gentleman that literally wrote the book on playing nice but winning. Hello, and welcome to this week's theCUBE Research Insights powered by ETR. In this breaking analysis and ahead of DTW 2025, we examine the question, how will Dell capture the explosive AI opportunity while transitioning the millions of servers, arrays, and PCs it already has in the field into this new era? Our premise is that Dell will continue winning if it does the following things. 1, leans into end-to-end AI factory systems. 2, monetizes its vast channel. And 3, keeps modernizing its core infrastructure for power-hungry parallel workloads, while at the same time driving down costs and addressing energy challenges for customers. Now, at the 2023 financial analyst meeting, which was around October 5th or 6th of that year, Jeff Clarke presented this slide. So look, Dell dominated the PC era with their direct model. And then when the internet came, it leveraged e-commerce to sell PCs directly. And so it furthered that direct customer-to-customer interaction. Now, it tried to transition to becoming an enterprise powerhouse in that period where, the 2010s here, where you see revenue flattening and actually declining. As you may recall, they've acquired numerous companies like Compellent and EqualLogic and Storage, Perot Systems and Services, and a number of software companies. It was essentially a failed learning experiment. But it allowed the company, or forced the company, however you look at it, to go private. And it bought EMC and became an enterprise powerhouse. And it, of course, got liquid by selling the VMware asset. And now it's riding the AI wave. Now, if you take a look at the company's stock, right here, we pulled up a chart, a 5-year chart, and we'll annotate a little bit. It kind of tells the story. So it really illustrates the phenomenon of early AI. So you go back to January 2023. It's just, people were waking up to the ChatGPT moment. They announced ChatGPT in November of 2022. Hit the holidays, people were chatting about it. But in January, people started to really, pay attention. You can see the stock is at 40 at that point in time. And the company's revenue multiple was under $1 from a multiple standpoint. It was like pennies on the dollar, maybe 50 cents. I can't remember exactly. And then you see in October 2023, when Dell held its last financial analyst meeting and made the call, and they laid out that chart that I just showed you, and began to catch the AI wave. And the other thing, of course, Dell did is it started to initiate another lever that it had of doing stock buybacks and dividends. And then a year ago, the stock hit 160, which was 4x the price, around the time people started to grok that moment that AI wave was going to hit and Dell was going to be a beneficiary. And you can see it's now trading at around 112 as of this morning, about 3x of that January 2023 price. That's up 430% since COVID hit. And again, AI is one factor. The other big factor is that Dell returns 80% of its free cash flow to shareholders, of which Michael Dell is the largest shareholder. So, that's another big tailwind for Dell. I mean, buy-side investors love the fact that Dell is returning so much of its free cash flow. Topic for a different day, but I would just briefly say, if a company's doing that, it's great. It's propping up a stock price. It says that they see that buybacks as a better investment than R&D or M&A, and which M&A has pretty much dried up at Dell since the EMC acquisition for the most part. Dell's got a relatively easy business to understand. They make it easy to understand. If you bring up the next slide, thank you, Alex. So let's focus on fiscal year 2025. There's a breakdown of Dell's business model. It's roughly just under $100 billion company. I think it hit $100 billion during COVID and pulled back a little bit. But it's got two main line of businesses: PCs and enterprise. What it calls ISG, the Infrastructure Solutions Group, and the Client Solutions Group. Now, of course, it's more complicated than that. Within each, it's got granular businesses and multiple P&Ls, and it's got a services business. But we like the fact that Dell keeps the reporting relatively simple. So it's got a large business, about $100 billion. The largest segment of the business comes from PCs, mostly commercial PCs, as you can see here. And it's a low margin, high volume business that provides the underpinning of Dell's supply chain leverage. You remember when Hewlett-Packard split from HP Inc. and HP Enterprise, it basically lost that equivalent supply chain leverage in its enterprise business because the PCs were the volume business. Dell maintained that. And that's why they can claim, really, they are the premier end-to-end provider. And so then coming back to the chart, it's got a rather large, higher margin ISG, / enterprise business. In that business, it's got about 60% coming from servers and networking, the rest coming from storage. Storage is the higher margin business than servers. Typically storage, the top storage companies, Pure Storage is in the high 60% gross margins. EMC in its heyday was in the mid to mid 60% gross margins. They think Dell's, a little bit lower than that. But anyway, it's a significantly higher margin business, gross margin I'm talking about, than the storage, than the PC business, and considerably higher as well than the server business. Why? Because traditionally, Intel was making all the margin in servers. Now, of course, Nvidia is making margins. Now, services are pretty much spread throughout the P&L. I can't remember exactly how they account for that in the income statement, but it's in there. And those are kind of middling margins, but they're enablers to selling, other parts of the business. Now, again, during COVID, when PC demand spiked, Dell's revenue and cash flow shot up. But the product mix, because it favored lower margin PCs, it pressured margins. As AI server demand spikes, currently, the product mix pulls margins up into servers, and then as new storage cycles kick in, that's even better for margins. Now, software comprises very little of Dell's business. At one point, it recognized VMware revenue on its income statement, and Dell could have spun in VMware, and that would have really jacked up the margin profile, but Michael Dell and his financial partners chose a different path, selling the asset, as you know, to Broadcom. So this leaves Dell with a large, very large, $100 billion, just under, high volume, supply chain optimized, global, essentially hardware business. So it's a great business, but in a way it's not a great business when you compare it to other businesses and other competitors. So here's a chart. It's basically a financial model comparison, puts Dell in context, not meant to be exactly precise. We're using trailing 12 months in a lot of cases, but what we got is trailing 12-month revenue, gross margin, operating margin as a percent of revenue, operating cash flow, the actual dollars, that divided by revenue. So operating cash is a percentage of revenue, rough valuation, and a revenue multiple for each of these companies. And you can see, Dell at just under $100 billion. It's got a low gross margin business in the low 20s. It's got a 6 to 8% operating margin. Throws off cash, but 5% of its revenue goes to operating cash. Its valuation has actually gone up considerably. It's at revenue multiple of 0.8x. It was at one point under 0.5 a couple of years ago, and lower than that of HP. It's now surpassed Hewlett-Packard Enterprise, and you can see its profile there. Similar businesses. HPE slightly better margin profile, meaningfully better, but that's because it doesn't have the drag of the PC business, and it also doesn't have that supply chain advantage or the cash flow advantage. So pick your poison, but that's what HPE chose to do, and it's got a more focused and a more profitable business on a percentage basis. Now look at IBM. IBM at one point several years ago probably had about 30%, maybe less, 25% of its business was software. It's now up around 45%. And that's what's driving the gross margin. That drives operating margin. It drives free cash flow. and it's driven valuation. IBM's now up to about 4x revenue multiple, which is meaningful improvement from where IBM was prior to Arvind Krishna taking over. So they're going in the right direction. Cisco, great business, always has had margins in the mid-60s. Lately, they've had margin pressure, but great operating margin, outstanding valuation. Almost a 5x revenue multiple. Again, company shifting toward ARR. Now look at Oracle. Oracle's a software business, even though it's acquired Sun and it's got hardware, but comparable in size to Cisco. Gross margin north of 70%. It'd be much higher if it didn't have OCI. All the hardware investment and the CapEx that they have to put in, it essentially pulls that down. But it allows Oracle to maintain a differentiated advantage. But look at the operating margin, in the low 30s. Amazon-like, if I had Amazon on this chart, AWS, very, very strong operating margins, but you can see the operating cash flow for Oracle, surpasses all these other guys in its valuation. It's reflected in the valuation, and you can see as a software company, it's got that, 8x multiple. So look, as I said, Dell could have chosen to spin in VMware, and I've often said they could have been the Oracle of enterprise infrastructure. They chose not to do that for obvious reasons, so that Michael Dell and Silver Lake could get liquid, but that would have been an interesting thought exercise. All right, let's bring in some ETR data. If you bring up the next slide, Alex, this shows just a quick view of Dell's spending profile within a couple of segments. We're just listing here the laptops, cloud computing, because the customers do answer Dell is our cloud computing provider, so it's probably they're thinking private cloud, and then Dell storage, Dell server, and then Dell desktop. The lines represent, see that red box represent net score, which is a measure of spending momentum, and you can see we're plotting April 24, Jan 25, and April 25. And you can see there's downward pressure, and there's a reason that there's downward pressure is because budgets are under pressure. So this is not unique to Dell. This is a situation that sort of most vendors in the sample, if not all of them, are facing. Very few are showing, accelerated spending momentum. There are some, but so you can kind of see here, anything over 40% is considered highly elevated. And you can see Dell's a mature business, so it's got nothing in this chart over 40%. Having said that, the Dell laptop at 33% is very, very strong and very competitive. And cloud is respectable. If, Alex, you go to the next chart, this is the same type of view, but it's now showing that in that red box, pervasion. It's kind of a funny word, but it means penetration into the data set. So you can see Dell's penetration is very, very high. Dell laptop, 55% of the sample within laptop is Dell. Dell server, 53% of the server base of the survey sample is Dell accounts. Storage, 41%. I think globally it's storage market shares maybe now trending down into the 30s. Dell, I don't think Dell and EMC, maybe it's the high 30s. I'd have to check the numbers, but nonetheless, it's a major storage player. And you see same thing in desktop, almost 40% of the market in this survey. Cloud computing, much smaller, right? Doesn't have as high a penetration because it's really the private cloud, it's the on-prem crowd, et cetera. Now, Alex, go to the next slide. What we're going to show here is in context, the peer, the vertical axis is shared net score. That's again, a measure of spending momentum. And then the horizontal axis is penetration. The ETR calls that overlap. Overlap is an indicator of the percent of these products that are within those 1,859 accounts. And you can see in the upper right, Apple laptop and Dell laptop, are the kings of this chart. You see them in the green in that insert in the upper right, Apple laptop at 34%, net score, Dell laptop at 33%. So right there on top of each other, Dell with a little bit higher penetration. You can see that line at 40%. The whole sector is below that line. But anything in the 30% is very, very respectable, even the high 20s. If you go to the next slide, This is the server slide. Look at Dell's penetration. It's got a dominant position. You can see how the ends are plotted. If you look in the upper right, you see Intel, I'm presuming that's just, we got white box Intels, Supermicro, and Dell. Look at Dell, 537 shared N out of those 1,859 accounts. So I hope you get that. That says that of the 859 accounts, 1,859 accounts, 537 have Dell servers. Okay, so really significant penetration. But you can see, again, all of these server vendors, because it's such a mature business, are down below the 40% line. Now go to the next slide, Alex. This is storage. And storage and ETR, it's a mix of data protection and primary storage. And so you can see Dell, again, very, very high penetration. You can see the Dell has 323, more than anybody else in that shared N in the upper right. Its momentum is not nearly as high as Pure Storage. Pure Storage is actually above the 40% mark. The only storage vendor above that. Rubrik is right on it. Again, Rubrik really competes in that sort of data protection. They recast themselves as a security player, which has paid off very well for them. The other big competitors for Dell and storage have always been NetApp, and you can see they're very strong. Nutanix is in there, really not just a storage vendor. HPE, VMware with vSAN, that's all being now bundled in to the Broadcom stack. And you can see some of these other players. So that gives you kind of an indicator as to, how Dell stacks up. And, the bottom line is they are not like setting the world on fire from a standpoint of spending momentum, but they are highly penetrated. And so they've got that big install base, they're servicing that install base, and that is fundamentally the premise that we're working around today and we ask the question, how does Dell ride that AI wave and at the same time maintain that install base? And the way it does that is it bundles in, it makes new partners like Nvidia. It's going all in on Nvidia and the AI factory, but at the same time, it will continue to partner with the likes of Intel and AMD and other partners, but it's really transforming its stack to be AI enabled. We'll come back to that. So let's take a look at the macro and the whole backdrop here. AI is rewriting the data center, and let's ground the discussion in what the numbers tell us. This is our updated data center forecast that we did in April, updated from the one we did earlier this year, and it looks at all the data center infrastructure, the facilities, the power, the cooling, the servers, the storage, the networking, and it shows the total spending crossing $1 trillion, by the end of the decade, early next decade. And this is, growing at a very strong CAGR, mid-teen double-digit CAGR from 24 to 35. And you can see the deltas here between the traditional data center, that's the x86 predominantly. Yeah, there's some IBM Power in there and some Z mainframe, but it's, wouldn't even show up on if we had separate lines on that, very small, dominated by x86. But then the blue is accelerated computing or extreme parallel processing, EPP, we sometimes call it. And, we're talking about systems that are purpose-built for AI training and inference, and that's growing even faster at a 23% CAGR. And it moves from 8% of the market during COVID to 85% by 2030. So really a remarkable shift that we're seeing in spend. Now, what happens when we isolate on the AI spend and just look at what's happening there? Jensen in his keynote at GTC laid out 3 vectors of opportunity. One was hyperscalers / cloud. The other was enterprise, i.e. on-prem, and the third was robotics. And we mapped to Jensen's model, and that's where this data comes from. But let's take a look at cloud today and enterprise tomorrow. So when we isolate just the AI slice of this forecast, that's what this is. We see that the hyperscale clouds dominate in the early innings for good reason. That's the dark blue here. They have the CapEx head start. They have the cloud. They have the growth. They have the momentum. They have the cash. They have the software. They have the tooling. And of course, a lot of data gravity. So you can, experiment. But look, the model shows that on-prem has data gravity too. And so you've got data gravity and you've got you've also got compute gravity, GPU gravity tugging at each other. But there's no question that a lot of enterprises that we talk to are not going to move into their data into the cloud, so they're going to bring the AI to the data. So you can see here the light blue, grows through the small and then crosses the traditional non-AI on-prem spend from the previous chart around 2029, and it hits 20% of the AI outlays by 2032. So it's slowly growing, and that crossover year is around 2029. That's the moment that Dell is architecting for, because it plays directly to its install base of hundreds of thousands of global customers, a distribution channel that's second to none in the enterprise, and a services arm that they know how to walk the aisles of the data center, and they've got deep relationships there. So that's the interesting thing here, is that there's a lot of talk about AI and a lot of AI hype, but when you really dig into it and you peel the onion, those Dell AI servers, those HPE AI servers, those Supermicro AI servers, most of them are going to cloud service providers, either the neo clouds. A lot of Dell AI servers are going into the Memphis data centers where Elon is, and they're trickling in to the enterprise. So Dell's got twin mandates as we see it. We think Dell is executing on these simultaneous vectors. They got to retool the stack for AI, and kind of the watch list for Dell Tech World reads like a blueprint for an AI first data center. You got to protect and harvest the install base. The majority of the Fortune 500 workloads, they're still running on x86 machines, and many had that Dell badge. And so those systems need to interoperate with GPU clusters. You got to mount new storage tiers. We talk a lot about distributed systems and disaggregated systems and parallel file systems and vector databases, and connecting to Ethernet fabrics at 800 gig and up and beyond. And Dell's pitch essentially is, look, we're going to modernize what you have while we're dropping in the AI blocks that you need. So come along with us. At Dell Tech World, we're going to hear a lot about AI PCs. I'm sure we're going to have new announcements and product adoption metrics and innovation. We've been excited about the NPUs. Apple's got, was first with the NPU. There's a lot of chatter about NPUs. So we'll be watching for what Dell is announcing in AI PCs. There's going to be a lot of model numbers at this event, a lot of server model numbers, a lot of storage model numbers. It'll be a mind-boggling spate of models to keep track of. A lot of AI factories. We're talking about full systems designed for the AI era. We expect a lot of model optionality. Dell's all about choice. But we're gonna hear about what models are available. They've got partnerships with Meta, and they tout Llama and Llama Stack and many other companies that they've put forth with Hugging Face, model gardens, and things of that nature. So we'll be looking for anything new there. But they've also got to build in AI tooling and surrounding management capabilities because they're lacking in the enterprise, and we'll talk about that. Compute, you're going to see more servers, no doubt. Dell's, predominantly a PC and server company, and they, EMC brought the storage piece, but even those are running on, Dell, hardware, Dell server hardware. So they really are, compute first. And I think you're going to see silicon optionality. Nvidia, whereas Dell bet the farm on Intel, last era, they are betting the farm on Nvidia. Nvidia is the preferred supplier. They're pelling up to Jensen, and that's a smart move because Nvidia is leading this charge. But hey, they still have relationships with AMD. AMD, very strong story around inferencing. Intel's behind in GPUs, but they still sell a lot of x86. So Dell wants to make sure that those options are available for customers because, especially those ones that are price sensitive and looking for the value play with a focus on lower cost and even inference. Storage, AI optimized storage. Every part of the stack is becoming AI optimized. We talk about this all the time. We're likely to see some upgrades to legacy products to keep that install base happy, and new storage platforms and new storage architectures to appeal to AI. In networking, Dell's got a different strategy in networking, and the AI wave has allowed them to compete by bundling in integrated networking with ultra-low latency, very high bandwidth, partnering up with Broadcom, and offering high bandwidth, low latency networking. Same thing with, so that's on the Ethernet side and on the InfiniBand side with Nvidia's stack. So the focus is going to also be, we think, on the biggest data center challenges, things like power, cooling, space, density, performance per watt, and the like. So when you think about the product genealogy, you got the playbook. In the last several years at Dell Technologies world, we got varying doses of Project X, project code names, and the pattern was quite unmistakable. They'll tease a concept one year, ship a generally available SKU the following year. We heard this about, remember Project Alpine, Project Frontier, Project Fort Knox, Project Fort Zero, Project Helix last year. And that cadence tells customers, if you see a project on the stage this May, you can maybe budget for it next fiscal year, but caveat emptor is sometimes those projects get backburnered or sunsetted, so they don't always see the light of day. They usually see the light of day, but they don't always take off and kind of fade off into the background. So some risks to watch. Dell still faces challenges, right? The GPU supply chain remains, rationed. People are fighting for supply, meaning Dell's got to fight for allocation with hyperscalers. This on-prem trend is going to require liquid cooling retrofits, and that could stress legacy facilities. You got competitors from Supermicro, they got designed to order racks. You got HPE, AI servers, GreenLake's wrapped services. They're courting the same install base. And look, Dell's AI factories are primarily hardware, right? They have the Nvidia stack, but when you compare what's available on-prem from Dell with what's available in the cloud from the standpoint of data stack or governance layer, other tooling, it's more robust in the cloud. So Dell's got some work to do there. Well, there's some action around the data stack, lake houses, and leveraging Nvidia's software stack and bits and pieces from the ecosystem. Dell's AI offering lacks the startup contributions and innovations that you'd see in the cloud. Maybe we'll see some of that. It would be nice to see some of the startups partnering up with Dell, but we want to see dozens or hundreds. That's the road that Dell, we think, has to travel to compete more effectively with its cloud peers. And look, its data stack today is much less robust than what's in the cloud. It doesn't have a robust developer community. And ISVs today, they think cloud first, but that could change if Dell can provide that infrastructure base for them and, help them tap into that, on-prem estate where all that data still lives. Dell's got to change that perception and begin developing those on-prem solutions, attracting startups and enterprises to attack that light blue bar that we showed you before, which is that on-prem AI opportunity. So in our opinion, Dell's differentiation is not owning, the fastest GPU node. They'll get their allocation with everybody else, and they'll get to market maybe a little bit sooner. But that's table stakes. But they've got to orchestrate that end-to-end factory, the racks, the networking, the storage, the software, the services. Services are a critical part of what's happening here, and they're going to deliver that through the channel that already owns the Dell employees. They got the loading dock badge. They've earned the right, to walk around their customers. And so if Dell executes, it's going to be able to harvest the cash flows of its mature footprint. It competes because it's the largest. It's got the best supply chain. It can thrive on lower margins, and it's going to insert those AI-ready systems that are going to help Dell expand wallet share for the next decade. And the key dynamic that we're watching is the uptake of these AI factories beyond the tier 2 and the tier 3 service providers, and whether or not Dell can populate mainstream enterprises with AI systems. And so, to sum it up, our data suggests that Dell they're like threading a little strategic needle, is surfing the AI wave without wiping out its massive existing franchise. We're going to be on the ground with theCUBE at Dell Tech World all week, testing these assumptions, and of course, we'll keep you informed right here on theCUBE, and of course, breaking analysis. All right, that's it for now. Thanks to Alex Morrison, who is on production and manages the podcast, Ken Schiffman as well. Kristen Martin and Cheryl Knight help get the word out on social media and in our newsletters, and Rob Hof is our EIC over at SiliconANGLE. Thank you all. Remember, all these episodes are available as podcasts wherever you listen. Just search Breaking Analysis Podcast. I publish each week on thecuberesearch.com and siliconangle.com. Email me, david.vellante@siliconangle.com, or DM me at dvellante, or comment on my LinkedIn post. And check out etr.ai. They got the best survey data in the enterprise tech business. This is Dave Vellante for theCUBE Research Insights, powered by ETR. Thanks for watching. We'll see you next time on Breaking Analysis.